So, as I understand it, Matt, inflation is rising faster than wages, so everyone's going backwards, which is fueling the cost of living crisis. Have I got it right?
It's a fair characterization. We've seen inflation data recently come in at 3.8%. That's the headline data, and the trimmed mean, which is what the RBA focuses on, is at 3.6%. So inflation pressures are still there. That trimmed mean figure is month on month, so it hasn't changed. So it seems to be stabilized at this higher level. And so our real incomes are in decline relative to that.
So, how do we fix that?
So
We've
there was
got
also
two
some way.
levers, haven't we? We've got Michelle Bullock at the Reserve Bank, and we've got Jim Chalmers in Treasury.
So the best way to fix that would be to get on top of inflation. We have a relatively tight labour market. There was some labour market data that showed we added 76,000 jobs in June. The unemployment rate remains low. And so, absent the inflation, I think the labour market conditions are sufficient that we would get real income growth. And so, we really need to bring inflation down. And the predominant policy lever is to have interest rates at a sufficiently restrictive setting to do that. Now, the Reserve Bank is active. They have put up interest rates three times this year. It's at 4.35%. That's a rate that they feel is restrictive, and we're seeing a little bit of activity slow down um, in the market. But it's the question that remains is it going to be enough to slow it down quickly enough, given how elevated inflation has been for so long?
Well, my poor understanding of these things is that productivity is a big part of the problem. If we can get productivity up, then wages can rise with productivity without fueling inflation. Have I got that formula right?
That is true. The only way to grow real incomes over time is to see productivity grow, and that's growing the value of your outputs. And so one of the ways, back to the other lever, policy lever, fiscal policy, that we can potentially get an uptick in productivity is for government spending to pull back or pare its impulse to allow the private sector, which is where we get productivity from. It doesn't come from government spending, to allow the private sector to have access to resources that aren't sort of outcompeted by government spending at a lower cost to deliver a greater value output on those resources to deliver productivity and therefore higher incomes.
So that's not brain surgery. That's pretty straightforward, isn't it, in terms of macroeconomics? So everybody would understand that.
Mhm.
So,
I would think so.
so people have just made a policy decision that's different to what you're saying, and the price we're paying is flatline productivity.
Yes, government spending has expanded at a rate faster than the broader economy, and so because it's doing that, that's a policy decision to some extent. Now, it's not a policy decision squarely at the federal government. It's also in combination with state government spending, but yes, government spending is a decision.
Right. And at state level, who are the bad guys?
At the state level, where I think the biggest inflationary problem is, which is sort of creating the cost of living crisis, that's stemming out of a lot of the infrastructure spending programs, which directly compete with the resource inputs that we need to go into home construction. And we look at dwelling costs, that's the main culprit in driving inflation at the moment. And so it's the states who are delivering the big infrastructure programs who are having the sort of inefficient cost blowouts associated with those programs that are sapping some of the productivity capacity in other areas of the economy that's driving this inflationary outcomes.
Well, sitting in New South Wales, Victoria is the bad guy. Um,
Yeah.
true or false?
Victoria clearly has some spending issues. Its state budget is a mess. They haven't got any spending constraints. They've had huge inefficiencies, huge cost blowouts. But they're not alone. You know, we've got a big spending program happening in Queensland in preparation for the Olympics happening in there. WA has some cost pressures that are emerging through some of their infrastructure programs as well. So yeah, lots of issues.
Right. So, but Jim Chalmers says our problem is really influenced by overseas events. True or false?
So there's always some impact from overseas supply chains that might have been disrupted that create some cost input pressures that feed through to the broader economy. So trying to get an objective measure on how true that is, it would be helpful if you had a scorecard that sort of measured how Australia was performing relative to others. And We did get a scorecard a few weeks ago with an OECD report on changes in real income and changes in productivity across the 38 OECD countries. And in that scorecard, Australia was the fourth worst performer in terms of real incomes without outright declines over a 5, 6 year period. And we were the third worst in productivity per capita with outright declines over a 5, 6 year period. And so most other countries faced with the same impediments saw their productivity grow and saw their real incomes grow. So on that sort of more objective measure relative to other economies, we performed fairly poorly. And that's also, disappointing given that the more recent supply shock, we're a net energy exporter through our LNG channel. So we should have been a beneficiary from that to some extent. So yeah, a particularly damning sort of report with respect to how we've performed in the last 5 years.
So we're victims of our own decisions, really.
Yes, at this present point, we are.
Matt, thanks very much.
A pleasure.